We're breaking this down into 5 really simple steps today. 1. Meet the principal book. 2. Anatomy of a ledger. 3. The rules of posting. 4. Real-world ledger walkthrough. And 5. Balancing the accounts.
Section 1. Meet the principal book.
Think of the ledger as the principal book of accounts. It's basically an analytical filing cabinet where every person, asset, or expense gets its own specific, dedicated folder. According to our source material, after you record those original transactions in your journal, they have to be classified and grouped. The book that holds all these account sets, whether they're personal, real, or nominal, is the ledger. It is the absolute ultimate destination for determining the actual balance of each specific account. Now notice the fundamental difference here. It's a big one. The journal is your chronological daily diary. It just records things as they happen, day by day. But the ledger records transactions in an analytical order. It pulls out all the cash transactions, or say all the machinery purchases, and groups them perfectly together. That way, you can analyze them at a single glance.
Section 2. Anatomy of a ledger.
So let's talk about the standard specimen of a ledger account. You probably know it famously as the T account. It's split perfectly down the middle, debits on the left, credits on the right. You'll find that both the debit side and the credit side are basically identical twins. They each feature 4 specific columns: date, particulars, journal folio, which, by the way, is just the reference page from where the entry was taken, and the amount. Literally, every single account you open is going to look exactly like this framework. Section 3. The rules of posting. Okay, the process of transferring entries from the journal to the ledger means following a few exact mechanical steps. No exceptions here. First, you open a separate, distinct account in the ledger book for every single item. Second, when you're posting transactions on the debit side, it is strict practice to use the word to in the particulars column. And third, when posting on the credit side, you always use the word by in the particulars column. And this brilliantly illustrates a key point. The words to and by don't really have intrinsic meaning on their own, but they're used to cross-reference the corresponding opposite account from your journal entry. Guys, this is the golden rule. The concerned account debited in the journal should absolutely be debited in your ledger, but the reference you write in the particulars must be of the respective credit account. That is exactly how the two halves of the transaction stay linked together. Section 4. Real-world ledger walkthrough. Let's put this into practice. Imagine you're opening the books for the very first time because Mr. X just started his business with $20,000 in capital. In your journal, you'd have a debit to cash and a credit to capital. Let's see how that actually maps over to the ledger. Since the business is receiving cash, our cash account asset increases. So we post $20,000 to the debit side. And, following that golden rule of cross-referencing we just talked about, we write to capital ASC in the particulars. Make sense? We're in the cash account, but we're writing the name of the opposite account. Simultaneously, we open up a totally separate capital account and post $20,000 to the credit side, using by cash ac account in the particulars to show exactly where that money came from. The dual aspect of accounting is perfectly maintained right there across 2 distinct T accounts. Now, what about buying on credit? Let's look at a second transaction. Mr. X purchases $4,000 worth of goods from Y on credit. In the journal, this is simply a debit to purchases and a credit to Y. So we open a purchases account and debit it by $4,000, writing to Y to represent the vendor we owe. We're really just focusing on the debit side here to show you how smoothly that journal entry drops right into the analytical T account structure.
Section 5. Balancing the accounts.
All right, once all your monthly transactions are posted, it's time for the final step. The crucial point here is understanding these 2 terms. Carried down basically forces the 2 sides to match at the end of the month, while brought down is the reality of what you start with the next morning. First, you find the difference between the totals of the debit and credit sides. Then you use balance CD to plug that exact difference into the lighter side, making both columns perfectly equal. The very next day, you write balance BD on the opposite side to open up the new period.
But keep in mind, you don't balance everything. Nominal accounts, like our purchases and sales accounts, they get swept right into the profit and loss account at the end of the year. They don't carry forward. Real and personal accounts, however, like our cash, building, or capital accounts, are balanced, and they carry their balances forward to reflect in the balance sheet. Listen, this is a huge trap many first-year students fall into on exams, so definitely commit this rule to memory. Take a building asset account, for example. You might start with a debit balance of $10,000. At the end of January, the buy balance CD of $10,000 is inserted on the completely empty credit side, literally just to make the columns equate. Then, like magic, it's brought down as 2 balance BD on the debit side to kick off February. Seeing those perfectly matching totals of $10,000 at the bottom of both columns, man, it proves you've balanced the ledger successfully. Honestly, it's an incredibly satisfying feeling to take a chronological mess and turn it into this perfectly balanced mathematical proof. So I'm going to leave you with this final test question from the source material. If your total debit side outweighs your credit side, what type of balance do you actually carry forward as your opening balance? Think back to that building account we just walked through. Ponder that as you continue to study, and hey, thanks for joining me for this explainer on mastering the ledger.